objective questions, important theory, and various numericals. So follow the series completely. Okay, let's start. Okay, so first question: the credit arranged by the buyer, importer, from a bank or financial institution outside India to settle the payment of imports is called as. Now understand this question properly. The credit arranged by the buyer from a bank, okay, outside India. So buyer from a bank outside India means what? This buyer is from India. Understand this properly. These are important points. Okay, this buyer is from India. Buyer. Okay, and now this buyer is arranging for credit from some bank in foreign. Let's say USA. USA. Let's say Citibank. Okay, Citibank. So this buyer is arranging for credit. So loan is given by Citibank to this buyer in India. This buyer contacts the Citibank and gets the loan. So this is called as what? Outside, to pay the settlement of imports is called as what? Means this buyer has to pay for imports. For that he is getting a loan. The loan can be got through two ways. One through India or through outside. If he gets through India, then it's a simple loan. If he gets through foreign bank, then it's called as what? Buyer's credit, supplier's credit, trade credit, or ECB. Think over it, everyone. Answer it properly. After thinking properly, answer it. You'll get confused in two parts, I'll tell you. What are those? Okay, I'll give you the hint in this. Answer is between A and D. A and D. Now you think over it. Yeah, it is. Here the answer is called as buyer's credit. Remember this. Buyer's credit it is called as. ECB is also a part, means buyer's credit is a part of ECB, external commercial borrowing. But external commercial borrowing is about $20 million and it is about 3 years. Any loan taken from other banks outside India, okay, within 3 years and within 20 million by this buyer or any person is termed under buyer's credit. Okay, what is supplier's credit? I'll come to that later when the question comes. Okay, trade credit means what? This trade credit is a, here understand the concept again. Here trade credit consists of two parts. It consists of two parts. Okay, one is buyer's credit, BC, and second is supplier's credit. Okay, so the whole term is known as trade credit. So whenever the buyer arranges for this credit, it is known as buyer's credit specifically. Which of the following is not correct regarding Asian Currency Union settlements? ACU settlements. Now what are ACU? ACU are the 9 countries in Asia which have formed something called as ACU dollar. Now ACU dollar is not a separate dollar. It is the same dollar, but it is done as a netting effect. Means, for example, if India sells to, let's say Myanmar, okay, Myanmar, okay, Myanmar. If India sells to Myanmar, okay, and Myanmar also sells something to India. India sells to Myanmar and Myanmar sells to India, both. India sells, let's say, $100 and Myanmar sells, let's say, $40. So the difference is called as $60, which is positive for India. That is known as ACU dollar. That is reported to the USA. That is known as ACU dollar. So ACU dollar is not different. ACU dollar is a netting effect. Okay. So which of the following is not correct? Now we want not correct. Huh? There are 9 countries in ACU. The last country to join ACU is Myanmar with effect from 2010. Settlements takes place through ACU dollar or ACU euro. Separate dollar or euro account is required to be opened to distinguish the ACU. So which is this correct one? Again think. Yeah, it is. Which is the wrong one? Wrong one is this. The last country to join ACU is Myanmar. Myanmar with effect from 2010. Myanmar is not the last country. Okay, Myanmar has joined long back in 2003, 4 almost 2, 3, 4. At that time, remaining all are correct. There are 9 countries in ACU. Okay, settlement takes place through ACU dollar or ACU euro. Both of them are there. Separate dollar or euro account is to be maintained. So we need to have a separate ACU dollar account or ACU euro account with the banks which we deal in within these countries, these 9 countries. Okay. Now there are these 9 countries. I can tell you some names: India, Pakistan, Burma, then what? Myanmar, Nepal, Iran, 6, and there might be 3 more. Okay. So these all 9 countries form together the ACU unit. Okay. Export declaration form is not required to be submitted by the exporter if the value of the export consignment is. So EDF is not required to be submitted if the value of the export which is to be made is up to USD 1 lakh, up to USD 50,000, up to USD 25,000, and up to USD 10,000. Think over it now, everyone. Yeah, the answer is yes, everyone. 25,000, right? USD 25,000. So EDF is not required to be submitted if the value of the exports is up to USD 25,000. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel right now, because in this channel you will be getting the latest updates of from IIBF. Number one, number two, free YouTube series on all the subjects of your JIB and CIB plus other bank promotion exams. So click on that bell icon, subscribe to it immediately. Okay. Form ETX is used by. So ETX, where is it used? AD when they extend the time period of pre-shipment loans. AD when the post-shipment loan is written off. Exporter while seeking the extension of time for realization of export bill. Exporter for seeking extension of time for extending the period of pre-shipment loan. Now, what can be the answer of this? When they extend the time period of pre-shipment loans, or written off, or extension of time for export bill, or pre-shipment loan. Think over it. How many of you have started the studies? Tell me. Sincerely tell me. How many of you have started the studies? Type in the comment section if you have started the studies. Give me the answers also in the comments only. If you have started the studies, tell me. Have you started the studies? Everyone? Type yes. Yeah. So the answer is over here. What is the answer? Think. Is it pre-shipment? Is it written off? Is it extension of time? Is it that pre-shipment loan, extension for pre-shipment loan? Think over it. This is a difficult one. That's why you'll have to think more. The answer is ETX form. See this. ETX full form is extension form. Extension. Actually, it should have been EXT, but they call it ETX. Extension. The extension is always received for realization of export bill. Whenever your export bill is not realized within the time, now what is the time period? It is generally, earlier it was 12 months. Now because of that COVID, RBI started 15 months. Okay. So if your bill is not realized within 15 months, then you'll have to submit the ETX form to RBI through the AD, means through the bank. Okay. The credit directly extended by the overseas supplier to the of goods to the importer is called as. I told you I'll be discussing this supplies credit when the subject topic comes. Okay. So now think over it. What did I tell you? I'll be discussing the supplies credit when the topic comes. So now the topic has come. See this. What did we discuss earlier in buyer's credit? This was a buyer. Buyer was from India, right? Buyer. Buyer was from India. He arranged for the credit from USA. USA. Some bank he arranged. Bank. Okay. Bank. So bank gave him the loan. Okay. And then what did he do? By getting this loan, suppose loan was received from this bank in USA. So this loan is received by this buyer, and this buyer paid the supplier immediately. This buyer paid the supplier right now, immediately, today only. Okay, this was paid immediately. Okay. Now the difference between supplier's credit and buyer's credit is, here this bank is not giving the loan, so this is not there. Only this part is there. So here what will happen? This immediately will not be there. So this supplier will be supplying to this buyer with a credit period. Credit period means the supplier will be supplying for, let's say, 2 months, 3 months duration. Means I'll give you the goods now, you pay me after 2 months. So whenever any goods are sold on credit, on udhari, then that is called as what? Credit directly extended by the overseas supplier. So that is called as buyer, supplier, trade and ECB. Answer is simple. ECB, supplier's credit, right? Again, remember, buyers and suppliers are the part of trade credit only. Okay, remember this. Got it? Next one. No person in India can import or export unless she has obtained the following: import export code number from DGFT, authorization for DGFT from DGFT, authorization from RBI, import export code number from RBI. Now this is a simple JIB question. Okay, let me see how many of you can answer this. Got the answer? So it is import export code from DGFT. This IEC code is required by each and every person who wants to import or export in India or from India. Okay, compulsory. The supplier's credit extended by the overseas supplier for a period of more than 3 years is termed as. Again confusion in this. Here options are the same again. Buyer's credit, supplier's credit, trade credit and ECB, external commercial borrowings. What is it called as? Just now when I discussed a buyer's credit, I told you something. What was that? Think of it. Again, rewind this video. Go back. So, I told you that it is ECB, external commercial borrowing. Whenever any loan is beyond 3 years, it is called as ECB. See here, it's simple. Okay. Below 3 years, less than 3 years, and 3 years and above. What? 3 years over here. Okay. So it is ECB over here, ECB. And this is trade credit, trade. Now this trade credit is of two types, buyer's credit and supplier's credit. Okay, this is a basic classification between all these. So the answer over here is D, ECB, external commercial borrowing. Okay. The decrease in value, foreign value of the foreign exchange rate, which is done during the market due to the market forces, is called as what? So decrease in value of the this foreign exchange, which is done due to the market forces, is called as what? Think over it. What will be called as? Now look at the options. Appreciation, depreciation, devaluation and revaluation. Quite simple to answer. Think over it. Think over it. What is the answer? Got it? You'll get confused over here. Decrease in value. Decrease in value means it is either depreciation or devaluation. Either depreciation or devaluation. Now the confusion is between these two only. Is it depreciation or is it devaluation? Now look at this. Foreign exchange due to the market forces. Market forces. Okay. Now this is a trick. This will separate this depreciation from devaluation. So think about this. I'll explain this. I'll give you the explanation also. Not to worry. It is, see here, whenever market forces do anything, it is called as depreciation. Market forces. Okay, I'll mark this over here. Market forces. And devaluation is done when? Then I think so. There's a next question. Let's see. Is it there? Let me see if the question is there. No. So now I'll answer here only. Okay. So if it is done due to the government pressure, government interference, okay, if it is done by the government, in that case it is called as devaluation. Market forces, it is called as appreciation and depreciation. If the price increases, then it's appreciation. If it decreases, then it's depreciation. Okay, got it? Simple. Next one. Which of the following is not the correct value of the domestic currency? Not the correct value. Okay, which of the following is not the correct value? Correct in value, not value. Correct in value of the domestic currency. Devaluation is done by the government. Just now I told you. Revaluation is done by the market fluctuations. Appreciation is caused by the change in demand and supply. And none of the above. Not correct. Think over it. Think over it again. Okay. What do you mean by not correct? Not correct. Okay. Devaluation is done by the government. Okay. So is this correct? What did I tell you just now? Appreciation, depreciation is done by the market forces. Devaluation and revaluation is done by the government. So this is correct. So this is true. But I want false. So this is not the right answer for me. Revaluation is done by the market fluctuations. This is the catch. Okay. So this is false. Right. Appreciation is caused due to the change in the demand and supply. So demand and supply, that is appreciation, depreciation. So that is true. So we want not correct. Not correct is this. B is the answer. Revaluation and devaluation are done by the government. They are not done by the market forces. Okay. Market forces do appreciation and depreciation. Okay. Again, everyone, subscribe to Officers Adda 24/7 YouTube channel. Also, download this Adda 24/7 app on your mobile. Both the things you should do it now. Okay. Which of the following is correct? Devaluation in value of the domestic currency is caused due to the fluctuations in the demand and supply. Devaluation in the value of the domestic currency is done intentionally by the government. Appreciation is done intentionally by the government. Both A and B. Yeah. What do you think? I'm watching you. What should be the answer? Think over it. In the comment section. Give it in the comment section, everyone. Yeah. What is the answer? Yes, everyone. Devaluation in the value of the domestic currency is caused because of fluctuations. Devaluation is done by the government. Revaluation is done by the government. So this is false, right? So this is false. Devaluation in the value of the domestic currency is done intentionally by the government. Done. True. So one, I got it true over here. Appreciation is done intentionally by the government. Appreciation is done by the market forces. So this is false. Both A and B, that is obviously false. Okay, so the answer is B, only B. Okay, which of the following is correct? Only B is correct. Got it, everyone? Hi friends, welcome to the Scholar series of BFM. In this, we are covering the important objective questions, important theory, and various numericals. So follow the series completely. Okay, let's start. Credit risk. Now, what is the credit risk? Here, always remember, credit risk means relates to the credit worthiness of the buyer, could result in non-payment of the export bills due to any reason like financial crunch, default, insolvency, and anything. Now, understand, one important point about credit risk is always related to two aspects. Okay, one is a counterparty, and second is this country risk. Okay, let me draw it over here. Credit risk will always relate to two parts. Okay, one is country risk, country, and second is counterparty risk. counterparty, right? What do you mean by this? Country and counterparty risk. See here, firstly understand what is credit risk. Relates to the credit worthiness of the buyer, okay? Basically of the buyer, could result in non-payment of the export bills due to any reason like financial crunch. Now here the financial crunch is a typical question point given over here. Defaults, insolvency. Now all these points relate to the counterparty over here. Financial crunch of the counterparty, defaults by that counterparty, insolvency of that counterparty. Now, all these three aspects can definitely relate back to the country also. For example, I'll give you. Suppose if you have sold anything in, let's say, Afghanistan, any country, Afghanistan, okay, or North Korea, okay. What happens now? Even if your party is well off means if that party is ready to buy, say, give you the money, that party is good, financially that party is good, the transactions are good, everything is okay. But what happens typically, the country goes into default. Then also it's a risk. Because if tomorrow Taliban government says that no, nothing doing, no foreign exchange will go out of my bank from today. Even if your party is good, what will you do? Your payment is blocked, isn't it? This is a major problem for the country risk. This country risk has arose in many of the countries recently also. To name the few, all our neighbors, check all our neighbors, almost all. One is this Afghanistan, second is Pakistan. Look at this, what has happened. Look at Sri Lanka, what has happened, right? Means all these three countries, these are the major three neighbors of us. There is also Nepal, but Nepal doesn't have much foreign exchange as such, okay? So these three countries will always have always been the credit risky countries, to be frank, okay, because there is a huge country risk in this. Now counterparty means what? The country is good, but the counterparty is bad. Means your buyer is bad. Your buyer is not ready to pay. So this can be willful also. Suppose somebody is in USA, your buyer is in USA, your buyer is in Europe. So the country is good, the countries are good. But what is happening? Your buyer is not okay. So that's why I'll tell you, credit risk will relate to two parts always. One is country risk and second is counterparty risk. Okay. So credit worthiness of the buyer. How will you check the credit worthiness of the buyer? It's very difficult to check credit worthiness of the buyer. So that's why we should always, to cover this credit risk, we always try to use one element. What is that element called as? We always try to use LCs, letter of credit. Through LCs, the credit worthiness of the buyer is bypassed. Okay. So in LC, what do? We give typical, that bank gives us the responsibility, means gives us the assurance of payment on production of the documents, right? So that's why the credit worthiness of the buyer is gone and non-payment of the export bills by the buyer is gone. So typical credit risk is covered by LCs. Okay. LCs or even guarantees you can take. Guarantees means guarantees are also allowed. Okay. Financial guarantees. So they can be also allowed. So remember always, credit risk is always countered using LC or guarantee, or there is one more, but many of you might not know, but that is called as availization, similar to guarantee. Avail. Okay. Avail means giving a stamp on the bill of exchange. Suppose if this is the bill of exchange. Okay. Now here you are the drawer, you seller signs it, right? Here the buyer signs it, buyer. But in availization, what happens? This buyer also signs it, and here on this bill of exchange, face of it, bank will sign it. Bank will say, I will pay if the buyer doesn't pay. So this is a third party assurance you are getting, and that also from the bank, good bank. Okay. So that's why this is known as availization. So to counter the credit risk, we always have these three things: LC, guarantee, and availization. Okay. Now second is legal risk. What is a legal risk? Look at this. Let me remove this now, because this you have understood. Legal risk. What is the legal risk? Understand this. Relates to any amendment in the laws of the seller's or buyer's country which could result in inability of the seller to export
or of the buyer to remit the proceeds of the invoices. Means what? After all, this again relates to country risk. A part of the country risk. Here, country risk can have various parts. Country risk. It can have legal. Like as I said, just now I gave you this example of legal. Afghanistan. Taliban took over and then it's their own laws which are going on. So relates to any amendment in laws of the seller's or buyer's country which could result in inability of the seller to export or of the buyer to remit the proceeds, isn't it? Means seller is ready to export, your party is good. But the problem is the country is saying nothing doing, no more goods to be sent outside this country, no more exports, so everything is stopped. Similarly for buyer, no more money to be sent, forex to be sent outside my country. So that is also blocked. Okay. So country risk could relate to legal or there are various risks in country. I'll give you this pestle. This is known as a typical risk analysis, pestle. Every country is always measured based on this pestle. Political, economic, social, technological, environmental and legal. Always remember this. Pestle analysis is done for each and every country before doing any business with them or investing in any country like this. Okay. So this is a typical one. I'll give you one more example in legal risk. Suppose if you go in many of the Middle East countries, the checks which we have, checks in India, checks are typically for how many months? Maximum 3 months, right? Beyond 3 months, you can't use those checks in India. But in some of the Middle East countries like UAE and others, you have those checks which are being used for almost 2 years also. Because that is a legal process, legal system, right? In India, you can take the collateral, right? And nobody stops you. Suppose in some Middle East countries, the collateral is if it is to be taken, how can you take it if you are a foreign bank over there? You can't take it because there the laws are different regarding the property. So it depends on those laws. Okay, that's why it's called as a legal risk. Means whenever you have to enter any country for doing any business, you have to typically be sure that what are the legal problems in that. Okay. So legal risk continued. This could be due to the embargoes on the countries, ban restrictions on the export of a particular goods, ban restriction on remittance of funds to particular country. Now I'll tell you one thing like ban. What is ban or restriction of export on export? Look at this. Recently, India had banned this import of all these laptops, foreign-made laptops. Also export, I'll write it over here. Here, import of laptops was banned by India, right? Import. So this is again a legal risk. Import of laptops. Okay. Similarly, export. We have banned what recently? What have we banned? Can anyone tell me? What is the export which is banned by India now? Recently. Rice, correct. Rice is banned. Second, wheat is banned. Wheat. Okay, wheat is banned. Then third, what is banned? What is India banned? Many of the things are there. Onions have been banned now. Onions. These have been banned. So these are typical bans which arise within that country, which the country gives these bans. So embargoes means stoppages on the countries. Ban restrictions on export of a particular goods, ban restriction on remittance of funds. Okay. So funds transfer, like I gave you the example of Taliban, right? So these are typical examples of legal risk. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will get the latest updates from IIBF explained. Okay, updates from IIBF are explained over here, latest ones. Okay. So what is the point is many of the IIBF notifications which come are very difficult to understand by a common banker. So they are explained it over here. And second is you get free YT series, YouTube series. Okay, free. So whatever is free, I would suggest grab it fast, isn't it? Now similarly, see here, right now you are watching BFM YT series. Similarly, you can have the YT series on, you will be having it on ABM for ABFM, for BRBL, all the 4 subjects by different mentors. Similarly for JIB also you are having it, right? So subscribe to this channel, click on the bell icon, click on the like button, share it with your friends. Do it fast. Because remember, sharing is caring. That is very important. Okay? Country and political risk. Now what do you mean by this here? Just now we saw some part of the country risk, but again we'll see the political risk now. It relates to the development in the country of the buyer or seller leading to default in export or payment. So developments in the country, developments means these developments are always dynamic, remember, or buyer leading to default in the export or payments. Okay. So developments can be dynamic means suppose if the government changes in many of the countries, so immediately there are bans, right? Similarly, for example, right now in US, what is happening? They are coming up with the elections, right, in 24. So now the new candidate has told that he'll put a tax on India. Donald Trump, he has told that he'll put a tax on India if he comes to power. What is this? This is the intention of the political risk, right? Some other countries have also done the same. Means China. China is generally is not a friend of good friend of India. So it always tries to put some taxes, something on Indian goods, right? So these are all political risks. There are also friendly countries as such, like in UAE for India. They are typical friends. They have allowed freely everything. Okay. So relates to the development in the country of the buyer or seller leading to the default in the export or payments. This could be due to uncertainty in laws, right? Uncertainty in laws. Uncertainty in financial position of the countries. Remember, financial position of the countries. This is typical. Okay. Discordant relationship between the countries or fluid political situation. So discordant relationship between the countries means friends and foes. Means going against each other. Okay. Discordant means cross relationship. And fluid political situation. Fluid means what? Like if you see this fluid political situation, I'll give you a typical example. In many countries, like for example, in this Israel, if you check Israel country, they have so many elections. Every 7 months, they are nowadays having the elections, and the government changes. So that is fluid situation. If you go typically in South African countries, typically their government changes every now and then. So that is fluid political situation. Okay. So fluid means what? Very fragile political situation, right? So developments, uncertainties in law, financial position of the countries, and discordant relationships. These are the typical risks. Okay. Let me come to few more. Countries' weak forex reserves, good position could lead to the shortage of foreign exchange or inability to buy foreign exchange, resulting in externalization issues. Now, this is a typical and this needs explanation. Weak forex reserves. Okay. Okay, just tell me one thing. We'll compare. We are neighbors over here, India and Pakistan. We'll compare India and Pakistan. Okay. So now, India will say Bharat now. India is not India. We should say Bharat now because how can a country have two names, isn't it? So Bharat. Okay. So now, let's say in Bharat, what happens? Countries weak forex reserves. Look at this point. Right now, what are the forex reserves of India? Anyone knows? Anyone idea? Any idea? It is 600 plus billion. 600 plus billion. Okay. 600 plus billion. What are the forex reserves of Pakistan? Roughly 7 to 8 billion. 7 to 8 billion. Where is 600? Where is 7 to 8? So this is known as weak forex reserves. World Bank says here every time World Bank has given, and in fact IMF has given a simple rule. IMF says that which country is stable country? Which country do we call it as stable country? The stable country definition they have given, any country whose forex reserves are sufficient sufficient for next 9 months for imports. So that country is called as stable. Okay. Now look at India's 600 plus billion reserves. Every year, every month, India requires around. This is what the general whatever is found is around 40 billion for imports. Every 40 billion per month. Okay. Now we multiply it by 9. 9 for the 36. So 360 billion we require for 9 months. Right now, how much are we having? 600 billion. So we are much more than the stable. We have a best rating. That's why India is having nowadays, and this rating is very high for India. Okay, and it is going up constantly. So important point always remember over here. Countries' weak forex reserves will always lead to shortage of the foreign exchange and inability to buy foreign exchange, resulting in externalization issues. Now look, if you look at the inflation, if you look at the typical inflation, then what happens? If you look at the inflation, okay, inflation in Pakistan has rose heavily. Similarly, in Sri Lanka, rose heavily. Why? Because less of the forex reserves. Okay, this less forex reserves always leads to high inflation. So this is a typical reason. Got it? So that's why any country's forex reserves will lead to a problems of inflation, political problems, legal problems, social problems. All these problems here. After all, it's money. If you don't have money, nothing can means you can't play games with money. Either you have this money or you don't have the money, isn't it? Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material, plus live classes, ebooks, tests, everything. Whatever you need, you will get it over here. Okay? Operational risk. Operational risk relates to operational issues at both ends or even at the supporting organization's place. Means what do you mean by this? Both ends. What are the both ends? There is a typical here. Let's look at every export or import transaction. There is a typical exporter, right? From any country it is. Then second we have typical importer. The one who buys, right? Importer. Now the in between, how will the goods over here should reach from the exporter to the importer, right? But how will they reach it? It reaches through supporting organization, means shipping company. So shipping company. Okay, shipping company. So this is known as the third party or shipping the supporting organization. Relates to the operational issues at both ends or even at the supporting organization's place. Means if the exporter is having some problem, then that exporter won't be able to ship the goods. If the importer is having the problem, the importer won't be able to give the funds, right? Funds back, because funds should be received from importer. So importer won't be able to give the funds, right? Then strikes at the seller's factory. So this can also happen, strikes at the seller's factory or even seller's raw material supplier's factory. So if some exporter is getting some raw material from somebody to prepare the goods, right? So somebody is supplier to this exporter also. So if there is a strike or some problem with that supplier, even then raw material will not be received. So exporter won't be able to export, manufacture and export. Then this raw materials suppliers, transporters or loaders or banks or clearing agents anywhere. Even if there is a strike in the shipping company, there is typical strike over here, then also it's gone. You can't do anything in that case. So that's why operational risk relates to in any ways if you can't give the service. It can be due to strike, it can be due to dacoity, it can be due to terrorist attack, it can be due to floods, anything. Okay. Similarly, operational breakdowns or failures of systems, connectivity and communication, disruptions, commotions and other strikes or errors of by operating staff could lead to non-shipment or delay in shipment, shipment of defective or damaged goods, delays in making payments or receiving payments. So anything which relates to the stoppage of any transaction. So what are the transactions over here? Look at this. Failures of systems, connectivity, communication. So if there is no communication, how can you communicate with that guy in USA? Okay. Disruptions, commotions and other strikes, errors by operating staff. Errors by operating staff is also an important part. Huh? Error of commission and omission. We had this in your JIB, right? So these errors can also lead to huge problems. Could lead to non-shipment, right?
Hi friends, welcome to the Scholar series of BFM. In this, we are covering the important objective questions, important theory, and various numericals. So follow the series completely. Okay, let's start.
Let's start with today's part. The features of net interest position of the risk curve. Net interest position. What are the features of this? When there are more earning assets than paying liabilities, the rate may arise. Interest rate may arise if the market interest rate adjusts downwards. Again, means interest rate risk, I feel, yeah. Risk, interest rate risk may arise if the market interest rate moves downwards. Now, what is this? When there are more earnings than this, so assets are more than liabilities. Okay. Then what happens if the interest rate risk may arise if the market interest rate goes down, moves down. So if there are more assets than liabilities, what does it mean? I'm having more earning, right? My income is more because assets are more. So in that case, if the interest rate goes down, what happens? My earning will reduce. My surplus earning will reduce. So that's why I may be faced with the interest rate risk. So answer is A, correct. What about B? It may result in reduction of net interest income. So that is also true. It may result in reduction of NII. Right? What is the difference between NII and NIM? NII means what? Net interest income. Okay, and NIM. What is the difference between these two? NIM equals to NII upon earning assets, you call it. Actually, you can write it assets also, but it's actually earning assets, not NPA ones. Okay. So this is NIM, and NII means net interest income, difference between your liabilities and asset products. Okay, that interest earning. It will have impact on the economic value of the bank's assets, right? So that is also true. So C is also true. So the answer is D, all of them, isn't it? How many of you got this correct? Type in the comment section if you got this here. Be true to yourself, because in exam I won't be there. It's you who will be answering it. So be true to yourself. How many of you got this correct? D1. Type yes. Correct. Got it? So D. Which of the following are not the features of the price risk? Not the features. And price risk. Price means what? Price of the bond goes up or down. That is basically the meaning. Sure, always remember one thing. Interest rate risk, interest risk, interest rate, I'll call it rate, okay? Interest rate risk is always related to price risk. Both of them go hand in hand. Price risk, okay? Because the logic over here is if the interest rate goes up, repo rate, let's say, if the repo rate goes up, the price of the bond will go down. Price of the bond, okay? It always goes down. So it will go down. So that's why they go hand in hand. Interest up, price down. Interest down, price up. So which of the following is not the feature of the price risk? When the assets are sold after their maturity, it may result in price risk. So assets are sold after their maturities, after. Okay. So it may result in price risk. Is it so? When assets are being sold after their maturities, okay, I'm holding those maturities with me. So it may result in price, means the price may go up or down. Is it so? It will never, because after the maturity means what? Whatever is the final amount, I've got it over there. Now, when do I take it? That's a separate aspect altogether. Mature up to the maturity, only the price risk is there. This is known as operations risk. This is the part of operations risk. If you hold the bonds after the maturity also, means your operation team is not working properly. So this is when the assets are sold after the maturity, it may result in price risk. So not a feature. So this is, we want false one, and this is false one. Okay, so this is true. What about the second one? The price risk is closely associated with banks trading volume. Price risk is associated with banks trading volume. That is true, but okay, because the more the trading volume, more will I have the price risk. Banks may create such trading investments out of short-term movements in the interest rates. So that is also true. I can create investments by the short-term movement. So this is true, but I want what? False. So only A is the answer. When assets are sold after the maturity, it may result in the price risk. Okay, I'll clear this board over here. Okay, so that you can watch it freely. So this answer is A over here. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, whatever we require for clearing JIB and CIB, we get it over here. What do you require for JIB and CIB clearing? Three things only. Only three things. One is ebooks, means books basically. Second is test to check your knowledge. And third is classes. So all of them are over here. Okay, download it right now. Which of the following statements are not correct? Here, always focus on the question. Do they want correct or not correct, true or false, whatever. Okay. So this is they want false. Okay. Now focus on false. The bond prices and the yields are directly related. Directly. I just now told you in that second question only, right? That bond prices and yields are inversely related. Okay. So this is false. So you have got the answer. Is there any answer? All of the above over here? No. So others are not true at all. Move this, take this and move on. But let's see the other one, because now we are in the study session. In the exam, don't waste your time. Immediately move on. Okay. Market risk may apply for pricing risk for the assets held in the trading book. So market risk may apply for pricing risk for the assets held in the trading book. So that is true. There are two books in the banking. Always remember, trading, and second book is what? Banking book. Here the assets or the bonds are held over here for up to the maturity. This is for statutory purposes, CRR, SLR, and this is for proprietary, means buying and selling, earning profit. So that is true. So that's why this is not the answer. We want a false one. The market risk may also apply in foreign currency risk. So obviously, market risk means what? Which is not in your hands. What is the meaning of market risk? That risk which is not in your hands, right? Like Russia-Ukraine war, COVID, is it in your hands? Nothing. RBI changing the repo rates, it's not in your hands. So that's why market risk may also apply to foreign currency risk. So that is also true. So the answer is only A. Okay, clear, everyone? Everyone type yes in the comment section if you have understood up till now. Type yes in the comment section if you have understood up till now. Type yes, everyone. Let me see the comments. Yeah. Fast, fast, fast. Got it? Clear? Concepts are clear? Move on. Will you be able to answer in the exam? If it is asked, will you be able to answer it in the exam? Without remembering. So don't mug up. You need to understand this. Because mugging up is not possible in BFM at all. Not at all possible. Because the subject is so huge. And there are so many possibilities, so many numericals, so many case studies over here. Variety of questions are there. That's why I would suggest join this Sankalpa batch. Okay, I'll come to this later. I'll show you how to join it. We are covering all the numericals, objective questions, case studies, everything is covered. Okay. What is not a forex risk here? That's why they ask you these negative questions. Not. So we want not. False again. False. A risk may arise due to favorable exchange rate movements in the forex. It's called as forex risk. Favorable means I buy dollar for, let's say, 75 rupees. Okay. And now the dollar rate is 85 rupees. So is this a risk to me? I have brought it. See, I have purchased it. I have bought it at this rate. And now the rate is 85. Is it good for me? It is good for me, isn't it? So this is not a risk. This is false. And this is what I want. See, first only you got this answer A. But what about this? Now there is the option of all of these also. So these and these can also be false. This forex risk occurs on account of open position in spot or forward contracts. So this forex risk arises because of open position in the spot. Open position means what? Day end position, right? Open cash or day end cash, volt cash, what we say. In our bank, we have volt cash. Same logic, volt position, day end position. So this will definitely arise because of this. So this is true. So obviously now don't even check this third answer, right? In exam, don't check it because you know this is true. So all of them can't be the answer. So A is the answer. Now for just checking this as we are in the study mode, that's why it is applicable to individual foreign currency. That is also true. Individual foreign currency means same logic. I brought dollar at 75 rupees and now it is 70. Then it is applicable, right? So this is true, right? Everyone subscribe to Officers Adda 24/7 YouTube channel. See here, in this channel, you will be getting the free YouTube series. Okay. Plus, we are having Instagram channels. Free YouTube series on all the subjects. We are having Instagram channels, LinkedIn channels. Join them ASAP. Okay. I'll show you how to join them. These are the features of the basis risk. Basis risk means what? What is meant by basis risk? The rate of interest of liabilities and assets means deposits and this loans changes differently in different magnitudes. ROI changes differently means the rate of interest of deposit changes by 2% and rate of interest of this loan changes by only 1%. So that is known as the basis risk. When the interest rates of different assets, liabilities and off balance sheet items change in different magnitudes, it is called as basis risk. What is it? Now you tell me. Is A true? A correct answer? Yes? Type yes if you feel A is the correct answer. Interest rates of different assets, liabilities and all these, okay? So A is correct, okay? But there is the option called as all of these. So that we'll have to check now. All of these means I'll have to check B and C also. When the interest rate of assets rises in different magnitudes as compared to the interest rate in the corresponding liability, which may result in variation in net interest income, it would be known as basis risk. So again the same, wording is different only, logic is same. Assets interest rate rises with in different magnitude than that of the liability. That's it. So B is also true. So once you get A and B true, immediately you jump to D. Okay, because obviously C will be true, isn't it? So the basis risk is quite visible in volatile interest rate scenario. Obviously, volatile means high changing interest rates, very high changing. Okay. Right now in US, the same thing is happening. If you check USA, they are facing the same crisis now, volatile interest rates. Okay. Which of the following is not correct regarding the basis risk? Not. So again, we want what? False. Always immediately mark this. You want false answer. When the variation in the market interest rate affects net interest income, income to expand it, it will be unfavorable basis shift. So variation in the interest rate affects the net interest income to expand it, it will have unfavorable. So net interest income is expanded. So it will have unfavorable. Expanded means what? My net interest income is increased. So if it is increased, then is it unfavorable for me? So that is false, obviously, isn't it? So this is gone. So A is the only answer. Don't even look at B and C because all of these is not the option. So A is the only answer. But then also, today we'll do it. In exam, don't do it. Exam, just move on. Okay. When the interest rate movement causes net interest income to contract, the basis would be moved against the bank. So obviously, net interest income to contract. Contract means it is against me, in unfavorable to me, isn't it? So that's why B is true. So this is not the answer. We want false. This is true. Okay? True. The loan portfolio is funded out by of a composite liability portfolio. This causes higher degree of basis risk. See here, composite liability. Composite means various liabilities. Liabilities can be saving, can be current, can be FD. So if I am having the composite liabilities, this will cause a higher degree of risk to me. Obviously, because all will change in different magnitudes. So that is true. We want a false one. Okay. Now I told you how to join this Officers Adda 24/7 YouTube channel. See here. On LinkedIn, this is for LinkedIn. Okay, LinkedIn. No, sorry, not LinkedIn. That's yeah, this Telegram channel. LinkedIn I generally use. Okay, Telegram channel. So this blue one is for Telegram channel. This black one is for your YouTube, YT. Okay, and this next one is for Instagram. So join all of these. Insta. Okay, join all of these. Scan this. Just scan this and you'll get it. Okay. Because as I told you, we cover all the important YT series, all the important questions, important tests on these channels. Immediately join. Okay. The features of embedded option risk are, embedded option means what? What is embedded option risk? It means anyone can repay my loan. Suppose if I have given a loan to somebody, term loan or CC, customer comes tomorrow with all the money and says, okay, Tata bye bye, take your loan back. Deposit. Customer comes tomorrow with the slip, the deposit slip or that deposit receipt and tells me, Tata bye bye, take this receipt, give me my money. So this is embedded option risk, where the customer can withdraw their deposit funds anytime or repay their loans anytime. So which are the features of embedded option risk? When the bank is exposed to the risk due to prepayment, see here, prepayment of loan or premature withdrawal of term deposit, it is called as embedded option risk. Just now I told you, same, right? So A is the answer, but there is an option of all of these also. Check this now. This can be experienced in volatile situations. Volatile means too much changing rate of interest. This generally happens in volatile. Okay, so B is also the answer. So obviously now D will be the answer. C is true. The greater the magnitude of the changes in the interest rate, the higher will be the embedded option risk. So more the changes in the interest rates, more will be the embedded option risk. So that is correct. Okay. These things do happen in volatile situations, because what happens if the customer is having a loan with you, okay, and now due to volatility the rate of interest of the loan changes drastically. Right now you are giving the loan at, let's say, 8% to this customer, okay, and due to the volatile situation your bank increases the rate to 10%. So good customers will run away from you, run away, they won't stay with you. Okay, why? Because 8 to 10, whose 2% extra is a huge amount for larger loans. Okay, so this is embedded option. Which of the following is not correct regarding the embedded option? We want a false one now. Okay, this results in reduction of the projected cash flow. So not correct. Embedded option, reduction in the projected cash flow. Yeah, that is true. Okay, so we want a false one. Huh? It does not affect the bank's income. What is this? Does not affect. It is false. It does affect. So B is for B is the right answer. Don't even look at C and D now, because there's no option of all of these. If you want, I'll just go through it. Here, the risk may arise due to premature exercise of call put option. So that is true. What is call put option? Call put means the customer has a right to repay the loan or withdraw the cash. Okay, that is call put option. And D1, the withdrawal of deposit before maturity date would also cause embedded option risk before maturity, isn't it? Just now we saw that. So that is also true. So that's why I said in exam, don't even look at C and D. Immediately move on. Okay.
And some numericals. So let's start without wasting the time.
We'll be doing the objective questions. I'll be asking you the questions and explaining you as well. Not only I'll just ask you or give you the answers here. Answers are not that important. Explanation is important. Answers you can definitely get it in the books also, right? Which of the following foreign exchange operations have been useful in treasury management operations? Which of the following foreign exchange operations? So which of them foreign exchange operations have been useful in treasury management? Arbitrage, swaps, A and B both, and none of these. Now I'll tell you one thing. Firstly, give me the answer. Then I'll give you where are the loopholes. Type the answer. Is it capital A? Let's mark only this. A, B, C or D. What is the answer? Many of you have answered this C correctly. C is the answer. Right? But before going ahead to the next question, C is the answer, agreed. Have you understood what is arbitrage? Have you understood what is swaps? If you have not understood it and you are just typing, you have heard some word about arbitrage, you have heard some word about swaps, and you are saying, yeah, in treasury they are used. So I'll take both A and B. No, no, no. Don't do that. In BFM, you need to understand the things. That's important. Okay. What is arbitrage? Arbitrage means buying from one market and selling it to another immediately. For example, I'll give you a simple example. Mm, You we see that sabji wala, vegetable vendor, vegetables. The one who comes on the road near our house. Sabji le lo, bhaji le lo, right? That Nana Patekar. Nana Patekar, you remember in that movie? No entry. Aloo le lo, what gobi le lo. That sabji wala. What does that guy do? That guy does this arbitrage. What does he do? He buys it from the dealer. Dealer means distributor. Dealer. And immediately same day sells it to the retailer, means retail customers, to us. Let's call us only customers. Okay. So what does this distributor do? He buys it from this dealer and sells it to the customer on the same day. Okay. So today, if we today morning, generally this vegetable market is in the morning between 4 to 7 a.m. in the morning. Okay. There the whole wholesale market works, and after 7 a.m. this retail market works. So this guy buys it over here from the market on the same day, day one. Let's say D1 only, day one, and this guy sells it to the customers on the day one only. See here, vegetables can't remain for the next day. These are perishable items. Tomorrow, if somebody comes to sell you today's vegetables, immediately one can recognize that these are old or stale vegetables. So that's why this guy has to purchase only that amount which he can sell today. So that is arbitrage. Buying in one market and selling it into the other end, earning the commission on this. Similarly, in BSC and NSC also. Suppose if there is a Reliance share, okay, I buy it on NSC at let's say 2500, and immediately I sell it on BSC. Suppose there is a gap, price gap between these two exchanges for let's say this happens hardly for 4 seconds. 4 seconds. So there is a gap of 2500 over here and it is 2503. 3 rupees gap is there. So what will I do? I'll buy 1 lakh shares over here and sell 1 lakh shares over here. So what have I done? I want 3 lakh. 1 lakh into 3. 3 lakh. In how many seconds? 4 seconds. That is arbitrage. Safest. Okay. Swap means what? Swap is different. In swap, always remember, I'll just give you one basic over here for swap now. In swap, always there is one leg which is fixed. One leg that is fixed and other leg that is floating. Okay, floating. One leg is fixed, other leg is floating. For example, if I take 1 lakh rupees from you, 1 lakh, okay, and I guarantee you 7% rate of interest. So this is what fixed. I am guaranteeing you 7%. Okay, so this is going out. This is minus, right? For me, it is out. So I am guaranteeing you 7% rate of interest. So this is fixed. And what do I do with this 1 lakh rupees? I invested it, let's say, in the stock market. Stocks. Now these stocks can give me, either they can give me 50% returns also, right? Or they can give me 0% returns also, or minus also, minus 50% also. Anything can happen. So this is floating. So in swaps, always remember one leg is fixed and other leg is floating. Okay. So that's why the answer is both A and B, and these both the operations are used in forex as well as in the treasury bonds also. Risk in trading securities may arise from the following. So trading in securities may arise from what? Now this is a very simple answer. Trading in securities may arise due to what? Number one, foreign exchange transactions. Second, equity holding. Third, lending and repos, and all of these. So trading securities may arise because of what? This forex. Definitely, if the rate of the dollar goes up or down, definitely that will affect it. Equity holding. How much equity I am holding? Equity holding means what? Suppose if I am holding the shares of, let's say, Infosys, Reliance, TCS, all these companies. So that is my equity holding. So if it goes up, share market goes up, stock market goes up, I'm benefiting. If down, I'm losing. Lending and repos. This is basically related to bonds. Remember, lending and repos mean repos are the, what do you mean by repo? Everyone, what is the repo? Repo is the rate at which RBI lends to the banks, right? RBI gives money to the banks at repo. Hmm? Remember, this repo is traded in the market. Traded. You'll say how can it be traded in the markets? Here, repo is what RBI has given you money at this rate. Okay. So if tomorrow after 6 months or let's say after 3 months the repo rate decreases, then it will be this the rate at which it was given earlier is at higher rate. Let's say it is 5%. Example I'm giving you. After 3 months it becomes let's say 4%. So the one who is holding the 5% repo will be at an advantage. So that's why it is traded. So here trading is done wherever there is a gap in the interest rates. Trading is done everywhere. So the answer is all of these over here. Okay. Which of the following is not an agency service of the bank? Agency service. Agency means what? Here the bank is acting as an agent. Agent. Agent means what? LIC agent. Remember this? LIC agent. Insurance. Or any other agent also. Means mutual fund agent. What does the agent get? Agent gets only commission. Same thing, bank also gets only commission in agency services. So which of them is not the agency services? Extending credit, escrow, merchant banking services, and insurance selling. So which of them is not the agency? Not. They are not acting as the agents. Now very easy one but tricky one. You can immediately see the answer. Let me see how many of you can answer over here. Correct. Extending credit. It is not an agency commission over here. It is the core business of the bank. What is the business of the bank? Basic business of the bank, right? Deposits and loans. So extending credit is a basic business. Escrow, merchant banking services, insurance, and these are all agency services. Okay. Escrow will take a lot of time. Otherwise, I would have explained you. Escrow is actually, I'll just give you one liner. Escrow is a temporary account. When two parties don't trust each other and they have some funds in common or something in common. This is generally done in road contracts by large companies or even two buyers and sellers in different countries. If they don't want LCs, okay, they don't want the cost of LCs, so they use this escrow account. Temporary accounts, yeah, the funds are kept in the bank account, right? And it can be taken by, means it can be withdrawn by the sign of both, okay? It's like a joint account, okay? So escrow account is that. Merchant banking services, again, one liner only. Merchant banking means basically whenever you have that IPO, right? Reliance IPO, TCS IPO, all these IPOs. There the services are given by the bank as merchant banker. And insurance selling, you know. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, whatever we require, you get it over here. So that's why download it right now. Okay. And don't just download it. Start studying also. Otherwise, how many apps do you have in your mobile? How many apps do you have in your mobile? Can you even tell me the number of apps? Not possible. My second question, how many apps have you actually used in last 1 week? How many apps have you actually used in last 1 week? I'll tell you. WhatsApp, right? WhatsApp is the app you have used. Some banking app you might be dealing with, any bank, right? If you are dealing in shares, then this app of this DP, right? Then what? Nothing else. That's it. And some YouTube and all these things. So that's okay. So we don't use the apps that much. We just download them and keep it for some time, and that sometime never comes. Same thing should not happen with this app. Download it and start using it on a daily basis. Okay. What is off balance sheet risk? Off balance sheet, which is outside the balance sheet. Off balance sheet. Okay, it is contingent in nature. Means contingent means what? It is not for present, but it may come in future. It can occur on account of issue of guarantees. So guarantees is what? Again contingent, come in future, right? Bank's commitment may happen on account of failure of to meet the payment obligation. That can also be possible. Means when I issue the guarantee, what does it mean? I'm telling somebody, if this guy doesn't work, I will pay you, whatever your losses are. So actually, if this guy doesn't work, then what? I'll have to pay it. So that's why it may get converted into cash, and this is known as crystallization. Crystallization means crystallization means converting the contingent liability into real liability, means cash flow liability. So the answer is this. Oh, let me get it from you. So what is the answer? Contingent, guarantees, crystallization. What is the answer? Off balance sheet. It is D. All of the above, correct? All of them are the off balance sheet items. None of them is of the on balance sheet items. What is the off balance sheet item? Off balance sheet item means here I don't pay cash right now. Right now I don't pay cash. That is off balance sheet. Balance sheet item means what? There I pay the cash. CC term loan, I'm paying the cash. Guarantees, I'm not paying the cash. Okay. Which of the following statements is correct? Now I want the correct one. Okay, correct. You should always mark what is required in the exam. Correct or non-correct. True or false. Whatever. Okay. The funding risk may arise from the need to replace the net outflows due to unanticipated withdrawals of the deposits. So net outflows, whatever outflows are there due to unanticipated withdrawals, everyone is coming for withdrawal. So you'll definitely face the funding risk. There won't be any money, right? If everyone comes for withdrawal. So is this correct? Yes, A is correct. What about B? Now I want to answer from your side now. Time risk arises when the performing assets turns into NPA. Is this true? Time risk, what is time risk? Let me explain you, but I won't be answering this now, whether B is correct or not. That is what you should answer. Time risk means what? It's a part of liquidity risk. Here in liquidity risk, I don't get money on time to pay for my liabilities. That is time risk. Now tell me whether this B is right or not. When asset turns into NPA, means my performing asset becomes NPA, then I won't be getting the interest, whatever that asset was going to give me, loan was going to give me. So that's why it is again 2. So if 2 are correct, obviously this answer will be D. Let's see the third one also. Call risk arises due to crystallization of contingent liability. Just now we saw. Crystallization of contingent means what? If I give the guarantee on behalf of somebody and that person does not perform. So in that case, what happens? If that person does not perform, then I'll have to pay for the losses of that third party, isn't it? So when I have to pay for this is called as crystallization, and this is known as call risk. Okay. So third is also true. Okay. This is also true. So the answer is all of these. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you'll be getting number 1, free YT series on all the subjects, and number 2, latest updates from IIBF regarding the exams. They give various notifications. This timing change, that timing change, this portion added, that portion added, something, everything. Okay. The features of interest rate risk are interest rate risk. What is interest rate risk? Interest rate risk means the interest rates may go up or down depending on what the RBI is doing or whatever this foreign situations are, means world situations are. So that is interest rate risk. It is an exposure of banks' financial condition to adverse movements in the interest rates. Financial condition to adverse movements. Here, adverse movement means against your will, means against your wish, you can call it. Okay. So it is it that? Yes, it is that. What about the other one? Second one you give me. It has no effect on net interest margin. It has no effect on NIM, net interest margin. I know many of you have typed this answer D now. D. I am seeing D answer. All of these. But remember, all of these, D is We generally have the tendency of marking all of these, none of these, either A or B. We have the tendency of marking them as an answer, but it's not always correct. Okay, so here B, it has no effect, that is wrong. It has an effect. Interest rate risk will definitely affect my NIM. It may not affect the market value of the equity. That is also wrong. Market value of the equity means whatever is my stock price. If I'm facing an interest rate risk, immediately the stock market grasps it and knows it that yes, I'm facing the problem. Immediately my stock price is affected. So answer is only A over here. Okay, only A. Which of the following is not a mismatch risk? Mismatch. What is a mismatch? Mismatch means assets and liabilities mismatch. Okay, not. We want not, but not a mismatch. Always focus on what is required in the exam. Okay, holding assets and liabilities with different maturities and amount. Is it not a mismatch risk? Liabilities I'm having for 3 years, assets I'm having for 1 year. Is it not a mismatch? Yes, it is a mismatch. So I want not a mismatch. This answer is true. I want a false answer. This is what is my requirement? F. This is my true. T. Adverse movement in the interest rates. So is it not a mismatch? Adverse movement. Yeah. See this. Let me see the answer from your side. What is C? When the liability is repriced on maturity date and this causes variation in the interest rate. So what is this? Firstly, tell me about B. Adverse movement in the interest rate risk. Is it not a mismatch or is it a mismatch? It is a mismatch. Why? Because adverse movement in the interest rate risk will definitely affect me. For let's say same case, asset for 1 year, liabilities for 3 years. If the interest rate moves in adverse directions, it will definitely affect my asset and liability positions or my net profit over here. What about the C? When liability is repriced on the maturity date, this causes variation in the interest rates. So, when liability is repriced, see, this is known as repricing, reinvestment risk, repricing risk. So, this is not a part of mismatch. This is false. This is a reinvestment risk. Okay. How to join the Officers Adda 24/7 YouTube channel? Either YouTube or you can join the LinkedIn using this blue. Scan this QR code right now. Scan this black QR code right now for YouTube. This blue one for LinkedIn. This third one for this Instagram. Join immediately. We are giving various free YouTube series, various questions, various tests freely on that. What is the yield curve risk? Yield curve. Yield curve means it is yield. What is the yield? Yield means basically what are the returns I am getting from the bond. Formula is very simple. Coupon upon price, right? Into 100. Of course, everything is into 100 only. So this is yield. What is the yield curve risk? When I plot this yield for various maturities, here this is time. Okay, various maturities I plotted. So if I plot it for various maturities, okay, then the various the curve which I get is known as the yield curve. So when two different instruments maturing at different time horizon for price, assets and liabilities, so that is basically yield curve risk. So A is right. There may not be parallel movement in the interest rates of both the instruments. Means let's say this is 3 months bond and this is 10 years bond. So both of them will move differently. So that is also true. So once you get A and B as true, the answer will be all of these. Okay. So look at the third one also. Non-parallel movement in the yield curve may affect the net interest income, obviously. And net interest income will be affected if 3 months moves faster and 10 years move slower. So it will be definitely affected, isn't it? So that is again a yield curve risk. Got it, everyone? So what is the yield curve risk? Everyone has got this? Okay.
Welcome to Adda 24/7. We are in the Scholars series for BFM. Here we are covering all the important theories, numericals, and case studies and one-liners. Okay, so follow the series completely from start to end. Okay, let's start without wasting the time.
On 15th September, the customer requested for booking a forward contract for export bill for USD 1,50,000 to be realized in the month of December. Okay. Given that USD INR rate is 75.45 and 50, forward premium is as under. What is the forward premium? October is 18-19 paise, November is 30-32 paise, December is 41-43 paise. Margin to be charged is 0.05 paise per USD. Calculate the forward rate to be quoted to the customer. So this much is the question. So this question will be asked in exam for 5 marks. And they'll ask you various 5 questions on this. We'll discuss all these questions and all these topics over here. So understand what is happening first. It is export bill. What do you mean by export bill? This is the export bill. Export bill means what? Somebody is exporting the goods, right? And this guy will get the payments. Here, export rule is what? There is a seller in India or exporter in India, right? This guy sells the goods and gets the dollars. Okay, gets the dollars. Dollars means it can be dollar or any other currency, mainly dollars. Okay, so this guy sells the goods and there is a buyer in, let's say, USA, right? Buyer in USA, and this guy is in Bharat. Okay, so this guy is in Bharat and there is a buyer in USA. So what happens now? This guy sells the goods and this guy gets the dollars. So whenever we do the export transaction, the dollars are coming in for the seller. So bank has always to which type of transaction should the bank do in this? Bank should always buy the dollars. Okay, will always buy the dollars. And in import transactions, import. Bank will always sell the dollars. Okay, sell. In export, bank will always buy, and in import, bank will always sell, right? So now what we'll do? It is an export transaction, so we'll buy. Okay, so this is our first step. Done. Now in this first step, remember, there is an export bill. Now again remember, there are 2 types of bills, 2 types of rates. One is TT rate, and second is this bill rate, bill. There are other rates as well. There's the cash rate, there's a traveler's checks, TC rate. Okay. Then there's TT rate, then there's a bill rate. So cash rate and this TC rate, we won't consider it now because this is not applicable in this problem. Okay. Cash rate is applicable when you are dealing with the cash notes of the dollars or any currency. TC is when you are dealing with the traveler's checks. These are separate rates. Okay. So now coming back over here, TT rates. Okay. So now which rate will I apply? Will I apply the TT rate or will I apply the bill rate? So remember, TT rate is always applied when we are doing the transaction on the same time. Same time, no time difference. I'll write it simple, same time. Okay. If I'm doing the transaction at the same time, then I'll be applying the TT rate. And what is the bill rate? Bill rate I'll be applying when I'm doing, I'll write it over here, right? Bill. Bill rate I'll be applying when I am doing a future dated transaction. Future dated. Okay. So now in this case, which type of transaction are we doing? Are we doing the same time transaction or are we doing the future dated? Let's look at the problem again. On 15th September, see the date is 15th September. This guy has come to you. This customer has come to you. Okay. For booking a forward contract for export bill to be realized in the month of December. So this is a future dated transaction. You are doing a transaction for the month of December. Okay. So now, yeah, before going ahead, everyone subscribe to Officers Adda 24/7 YouTube channel. Just pause this video and subscribe it immediately. Okay. In this channel, you will be getting the latest updates on JIB and CIB, number 1. Number 2, you will be getting all the free YT series, free YouTube series. Right now, what are you watching? This numerical. You are watching the free YouTube series. So these free YouTube series, you will be getting it over here. So that's why subscribe to it immediately. On all the subjects you will be getting. Subscribe to the Officers Adda 24/7 YouTube channel right now. Click on the bell icon, click on the like button, share it with your friends. Okay. So let's move on. Yeah. So now what was that numerical? It was in September and it is for the month of December. Now look at this. We'll draw it over here. This transaction is happening on 15th September. I'll draw it over here. 15th September. And then it is for the month of December. See here, now understand one important point over here. It is maturing in the month of December. So in the month of December means what? See here, December is over here. So it is starting from December 1 to December 31. And this transaction is maturing in between. So it can be, let's say, December 10th. We'll take assumption. Okay, December 10th. So this December 10th, when I am having this transaction, it is within the month of December, year and year, right? So if I am having it in between, now what will I do? Whenever you have any transaction which is falling between, so you'll always use one maxim that is called as buy low and sell high. You'll always use this maxim, buy low and sell high maxim. Okay. Now what does this mean? Buy low, sell high. Between the rates of 1st December and 31st December, I'll have to choose the lower rate for buying and I'll have to choose the higher rate for selling. Okay. But what is this rate? How to get this rate? So look at these rates now. We'll draw it over here. Below this, I'll write it. Okay. 15th September. So first take the spot rate. What is the spot rate given? Look at this. 75.45 and 50. So this is my spot rate. So which one will I take? 75.45 or will I take 75.50? What do you say? Everyone give in the comment section. What do you say, guys? Should I take 75.45 or should I take 75.50? Everyone. I am doing a export transaction. So buy. Buy means what? Always remember, I'll draw it over here. Look at this. Left side is always buy. Right side is always sell. Always remember this. So I'm doing a buy transaction. So I'll take the left side. So left side means what? 75.45. This is the rate I'll be taking. So this is for spot, but see here, this is for spot. So 75.45. Now let's go to December 1. What is the rate for December 1 now? Let's look at this. See, this December rates are given as 18, 19, 30, 32, 41, 43. October is 18, 19. Now if you look at these rates, one thing is clear to you. What is it? 18, 19 means what? This, look at this. Whenever you have in any transaction, let me draw a line over here. Otherwise what happens? My video will come, means the writing will come behind my video. Okay, so I'll draw it over here. Up to here I won't write anything. Okay, this part. Got it? Yeah. So now look at this. 18, 19 passage. Whenever you have 18, 19 means whenever you have right side bigger, this side bigger in forward rate. Remember, this is not applicable to spot rate. When you are having this side bigger, right side bigger, the currency is in premium. Premium. Okay. So here, when the currency is in premium, you will have to add. Always remember. And when you have the right side less, then the currency is in discount. Discount. Okay. And then you subtract it. So in this case, what is it given? If you look at this rate, 18, 19, 30, 32. So 18, 19. 18, 19 means the currency is in premium. Right side is bigger. So it is in premium. But what do we want? Do we want this rate, 18, 19 rate? No. We want what? December rate we want it. December start and December end. So now remember, whatever rates are given, if the December rate is given, this rate is for the end of the December. So if November rate is given, it is for the end of the November. October given, October is for the end of the October. Now what do I want? I want the first rate of December 1. Okay, and then I want December 31 rate. So end of December will be December rate. So what is this December rate? 41. So I'll take this 41 paise over here. 41. Okay, because left side I am doing the buying transaction, right? So I'll get this. But what about December 1 rate? Is it given somewhere? What is the December 1 rate? Who can tell me the December 1 rate? Which rate will I take for December 1? Everyone, just give me the answer first. Yes. Which rate shall I take? Everyone, I'll be taking the rate of November end. Always remember, see this, November end equals to December beginning, isn't it? December beginning, right? It's simple. See this, it's like this. Your daily cash in your bank. How many of you are working in cash, have worked in cash? Either working or have worked, right? What have worked or working, anything. So always tell me what is your day end cash. Today's end cash will be the tomorrow's beginning cash. Simple. Same logic over here. November end rate will be the December beginning rate. What is November end rate now? So November rate, end rate is given as 3032. So which one will I take? 30 or 32? Everyone. Which one will I take? 30 or 32? Everyone be fast. I'll take 30. Correct. Left side. So it's always buy. So now I've got both the rates. December 1 and December 31. But I want the December 10 rate. So here what will I do? I'll use buy low and sell high. Now the currency is in premium. So I'll have to add the rates over here. Add the rates means what? What is my rate over here? 75.45 and 30 over here. So I'll add this 30 plus 45. So my rate will be 75.75 over here. And for this 75.45 plus 41. So 75.86 over here. Okay. So this is my 75 and this is my 86. So what should I use now? Which rate should I use? Should I use 75.75 or 75.86? Who can give me? Which rate will I use? 75.75 or 86? Everyone, be fast. Just now I have written it over here. Buy low and sell high. What am I doing? I am buying or selling? Everyone. Am I buying or am I selling? I am buying. So buying means what? Everyone, buying means which rate? I'll be taking this rate, low rate. So my final rate, not final rate. This is not the final rate. So the rate after this step is 75.75. But if this is 75.75, is this my final rate? No. Why? Because something is more given over here. What is more given here? Margin to be charged 0.05 paise. Look at this. Margin is to be charged for 0.05 paise. So what margin now? So it is directly given in paise. Margin is 0.05. So this much is to be charged. So what do I do now with this margin? Should I add this or should I subtract this? Who can give me? Should I add this or should I subtract this? Margin. I'll write it over here. Margin. This is generally called as TT margin. TT. Okay. TT or this exchange margin. So should I add this or should I subtract this? So remember, whenever you are doing a buying transaction, buy, okay, buy, you will always subtract the TT margin, subtract minus TT, okay. Whenever you are doing a sale transaction, sale, so you'll always add TT. So now what am I doing? Am I doing the buy or sell? Everyone just type in the comments, am I doing buy or am I doing sell? I'm doing buy, so I'll be doing subtraction. So what will be my rate? 75.75 minus 0.0. So 75.70. 5 minus 5, 0, right? 75.70. So this is my final rate. This is my final rate. Okay? Final rate. Now what do you mean by this rate? You need to understand that also. So this, your answer is over. See here, calculate the forward rate to be quoted to the customer. So your answer is over. Answer is 75.70. So what will you do with this rate? Yeah, what will you do? Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever you need for clearing JIB and CIB, you'll get it over here. So that's why download it right now. Okay. Chalo. Coming back to the problem, what will you do with this final rate? Okay, what is the amount? Amount is 1,50,000. See this USD 1,50,000. It's given over here, right? 150. So what will I do? It's an export. I'm buying. Buying means what? See this 1,50,000. Again, line over here. Okay. So 1,50,000 into what was that rate? 75.70. This amount will be multiplied. And what is the answer for this now? 75.70 into 1,50,000. Do it fast, everyone. Everyone do it fast. Yes. 1,50,000 into 150 into 0, 0. Okay, 1, 1, 2, 3. So this 1,50,000 into 75.70. So my answer is 1 crore 13 lakhs 1 crore 13 lakhs 55,000. Are you getting this, everyone? What is the answer you are getting? 1 crore 13 lakhs 55,000. This is the answer I am getting. So what will I do? This is in rupees. This was in dollars. Okay. So this 1,50,000 at this rate becomes 1 crore 13 lakhs 50. But what will I do with this amount? This amount I'm booking. Okay. So I'm buying this dollars. So I'll give this to the customer. If I'm booking the forward contract, so I won't give anything. Okay. Whenever I'm booking the forward contract, I won't be giving it. But if I'm doing the pre or post shipment in this case, then I'll have to fund the customer with this amount. Whenever I'm booking the contract, I'm not giving any amount to this customer. I'm just booking it and taking it a notional rate. Means notional this amount over here. Okay. But if you are doing a pre or post shipment, in that case, you'll have to fund it to the customer. Got this point? Got this numerical? This numerical was very important. This numerical is asked for 5 marks. So everyone, uncertainty. What is uncertainty? Under high uncertainty, banks tend to reduce loan growth, suffer more credit risk, and charge higher loan interest. What do you mean by this? Uncertainty means like in COVID situation, there was a huge uncertainty, right? Because banks were very afraid whether the loans given will be repaid back or not. So that was the uncertain situation. So under such situations, what happens? Banks tend to reduce their loan growth. They tend to reduce their loans, right? Suffer more credit risk because there is a huge credit risk because there was huge NPAs during that COVID situation and charge higher loan interest. So banks were charging higher, that is called as risk premium. Higher loan interest is called as risk premium. Okay, premium. So this is an important term under uncertainty. What happens to the banks during uncertainty period? Reduce the loan growth, everyone. Second, suffer more credit risk, higher credit risk, and higher rate of interest. Got it? Next is adverse selection. Now, what is adverse selection in this finance term? Is the difficulty to select and distinguish healthy companies with high credit rating from those that are riskier. Isn't it very important? And see, here the logic is simple, but if we don't understand it, then it becomes difficult, isn't it? So, adverse selection is basically difficulty to select and distinguish healthy companies with high credit rating from those which are riskier. How will you select these? This you get it from the rating agencies nowadays. See here, you can solve this problem using the rating agencies. Like we have Civil over there, then we have CRISIL over there. All these companies give the ratings to various companies. Okay, these private rating companies give the ratings to these private players like Reliance or Tata's or anyone. These are the big players, but there are also smaller companies. Ratings can be given to them also. So what is that? Difficulty to select a healthy company from the riskier company. It's that simple. Okay, so that's known as adverse selection. What is financial risk? Everyone, financial. Okay, you might be knowing this. Everyone knows the terms financial risk, but exactly what is required in the exam, that is the point of discussion, right? Otherwise, everyone knows what is financial risk, right? At a personal level, we always take the financial risk for investment in shares, for investment in mutual funds, right? But at a company level, at a CIB level, it is what is it? See, financial risk is the possibility of losing the money on an investment or business venture. Simple and plain equation, right? Plain definition. Losing the money. Whenever I am losing the money, it's basically the risk. Some more common and distinct financial risks include credit risk, liquidity risk, and operational risk. So These are the common and distinct financial risks. So common risk means what here? I always face the problem of credit risk. What is this credit risk? Credit risk means if the bank gives a loan to somebody, whether the loan will be repaid or not. That is known as credit risk. Whether it will be repaid or not. Okay. Liquidity means what? If I give too many loans, suppose if the bank gives a higher percentage of loan as compared to its deposits, then it will be facing a difficulty in paying the normal rate of interest also. Okay. Or normal liquidity risk it will face for paying the common bills. So liquidity means whenever you give the loan, you should always see to it that the loan percentage it has a maximum limit up to for the deposit purposes, deposit percentages. If I have given a deposit of rupees, if I am having a deposit of rupees 100, I must give the loan up to 70 rupees only. 70% is a good ratio for loans. Okay. So liquidity risk. And next one is operational risk. Operational means what? Operational risk relates to my operations. Means my employee errors or my system failure or my region failure, area failure. Area means what? There is a terrorist attack, there is a flood. So all these lead to operational risks. So financial risk also has these parts: credit, liquidity, and operational risk. Clear, simple. Risk adjusted return. Now tell me, what is risk adjusted return? Firstly, tell me risk adjusted means what? Okay, I'll ask you one question over here. Suppose if you are investing in FD of a nationalized bank or in a mutual fund, you are investing in a FD or in a mutual fund. Which of the investments will carry higher risk over here? Will the FD of the bank carry higher risk or will the mutual fund carry the higher risk? What do you say? Type fast in the comment section. Which one of the which one of the investment will carry higher risk? Investment in FD of the bank or investment in mutual fund? Obviously, isn't it mutual fund? So that's why the returns from those mutual funds are always called as risk adjusted returns. The risk adjusted returns measures the profits on the investment your investment has made relative to the amount of the risk the investment has represented throughout the given period of time. So what is the risk involved in this investment? Amount of risk, okay, relative to the amount of risk, that is important. Now if I invest in bank FD, then the risk is zero. Nationalized bank FD, then the risk is zero. Okay. But if I invest in mutual fund, there is the risk involved in it. So this risk factor I'll have to consider using my this other derivative products. So this risk is to be mitigated using the derivative products. So those derivative products will require higher cost. See here, if you are buying I'll give you a simple example over here. Okay. Suppose if you are buying Reliance right now, Reliance share. Okay. You are buying a Reliance share at let's say 2500, expecting it to go up. Okay. But if it goes down, then to cover this downside potential or downside risk, what do? This risk is covered using put options. But this put options, whenever you buy this put option will carry the cost because put option doesn't come for free. So this will carry the cost. So this is known as the risk amount of risk and it is known as the risk capital. Risk capital. How much risk capital I keep for my risk to cover my risk. Okay. So this is for to cover the downside. I'll buy a put and this put will cost me something and this will be known as my risk capital which I keep it aside. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CIB from IIBF. Means IIBF gives various notifications regarding dates, times, change in the subjects. So all these are immediately given on the Officers Adda 24/7. Also, you get free YouTube series, right? Free YouTube series right now. What are you watching right now? free YT series. So same free YT series, you get it for all the subjects. Okay, so subscribe to it, click on the bell icon right now. Okay, risk adjusted return on capital, RAROC. What is RAROC? Have you heard this term RAROC? Type yes in the comment section. Have you heard this term before? RAROC? Hmm? Type yes in the comment section or no. Whatever. Yes or no. So it is. Yes, I've seen many of them. Yes, 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 yes. Okay. So risk adjusted. We have heard the term, but we don't know the exact meaning of this. Risk adjusted return on capital means what? It is a risk adjusted measure of return on investment. Risk adjusted measure. Okay, what do you mean by risk adjusted measure? What do you mean by risk adjusted measure? Here. It does this by accounting for any expected losses and income generated from the capital, with the assumption that the riskier project should be accompanied by higher expected returns. So risk adjusted returns means what? See here, RAROC. So same as this earlier, we have seen one earlier definition just now. Similar to this, higher the risk, higher I'll be expecting the return. So higher expected returns. So if I'm investing in higher riskier projects, then I should get a higher return. Only then I'll invest in the higher riskier projects. Otherwise, won't I invest in the FD, bank FD, isn't it? So it does this by accounting any expected losses. What all losses can occur whenever I invest in some riskier project, okay, and income generated by that capital. So whatever capital I've invested, what is the income generated from that? Whether it suits my this risk adjustment. Okay. Same example. Suppose if I am investing in FD or in mutual fund. So definitely I'll expect higher returns on the mutual funds, right? Whereas in FD I'll be expecting lower returns. Risk management process means what? Managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. It also includes taking corrective measures to reduce the impact of the risk. So, what do you mean by this? Here, managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. Analyzing, forecasting, and making the predictions. Okay. So all the three steps are involved in risk management process. First is analyzing, second is forecasting, third is making the predictions based on the historical trends. Okay. It also includes corrective measures to reduce the impact of the risk. Corrective measures. What do you mean by corrective measures over here? Corrective measures over here means, suppose as I gave you the earlier example, if I am buying a Reliance share, then I must buy a put. Here, this is called as long position. Long means, suppose if I buy a Reliance share, Reliance, okay, at 2500, expecting it to go up. So this is my long position. Whenever I am having a long position in stocks or commodities, then in the this derivatives option or options market, I must have the reverse view. So in that market, I'll buy the put option. Put means what? If the market goes down, then the value of that put increases. Okay. So that's why whenever you are long on commodity, you must always buy put options to hedge that risk. And this is known as the hedging. Corrective measure means hedging. Okay. Maturity mismatch. It refers to the situation when company's short-term liabilities exceed its short-term assets. So short-term liabilities exceed short-term assets. What do you mean by this? We are talking of short-term only, okay? Short means deposits. If my bank's deposits will be higher as compared to the interest coming in, right? So maturity mismatches are visible on the company's balance sheet and can shed light because the interest difference will immediately be displayed. Well, after all, you can't hide anything from the balance sheet. Okay. Maturity mismatches often signify a company's inefficient use of its asset, isn't it? Company's inefficient use. It means what? If I'm having the loans, then I must use it properly. Properly means what? As a bank, I must see to it they are going to the basically to the productive assets, not to the NPA ones, right? Number one. Number two, it says, suppose if I am having a loan or if I take a deposit of, let's say, deposit, okay, if I take a deposit of, let's say, 1 year, of, let's say, 1 lakh, okay, and I have to give a loan against this, so the loan against this will definitely not be more than 1 year. Loan should also be 1 year or less, right? So if I give a loan of 1 year, it's market value of the equity. It is the total rupee value of the company's equity and is known as the market capitalization. What do you mean by this capitalization? Understand Reliance share because it's a known share to everyone, isn't it? So now, suppose if I take a Reliance share and this Reliance share, now this Reliance has issued, let's say, I'm giving an example, 1 lakh shares in the market. Number of shares is 1 lakh. So what is its market capitalization? So the market capitalization over here will be 2500 into 1 lakh. So 2500 into 1 lakh. So those many rupees, okay, will be the market capitalization of Reliance. Okay. So that is known as the market value of the equity or market capitalization. Total rupee value of the company's equity. This is the total rupee value of the company's equity. The measure of company's value is calculated by multiplying the current stock price by the total number of outstanding shares. See this, we have done the same thing. Current market price into total number of the outstanding shares. How many shares have been issued in the market? Okay, that is known as outstanding shares. Got it? So Reliance shares over here, the market capitalization will be, okay, give me the answer everyone. 2500 into 1 lakh. What is the answer? 1 lakh means how much will it be? Yeah, 2 crores. Then, yeah, 25 crores. Yeah, it'll be around 25 crores, right? 25 CR. That will be the answer roughly, right? Yeah. Coming back, chalo. Next one. Before going ahead, download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, whatever we need for clearing JIB and CIB, we'll get it over here. So download it right now and start studying. Okay. Next one. Downside potential. It is the estimation of of a security's potential loss in the value if the market conditions precipitate a decline in the security's price. Means what? Here, potential loss, keep it very simple. Potential loss due to decline in price of the security. Means, for example, we have studied this in our ABM also, okay, or in our JIB also. If the price of the bond, let's say, let me take Reliance only, okay, Reliance share. If I brought it at 2500 and if tomorrow the price of Reliance goes down to, let's say, 2000. So what is this happening? This is the downside potential. Securities potential loss due to the decline in the securities price. Okay. Depending on the measures used, downside risk or explains a worst case scenario for an investment and indicates how much the investor stands to lose. So worst case scenario means what? What is the lowest level which this stock can go down, or what is the lowest level at which this bond can go down? Okay. So worst case scenario over here is always taken into account by any company whenever you're doing a conservative investment. Okay. Indicates how much the investor stands to lose, how much this investor will lose if this downside potential means if the Reliance share goes down. Okay. Next is CCIL. The Clearing Corporation of India was set up in April 2001 to provide the guaranteed clearing and settlement functions for the transactions in money, government securities, foreign exchange, and derivative market. Remember, here it's not talking of stock market. So provide guaranteed clearing. Guaranteed means what? What do you mean by this guaranteed? Isn't anything guaranteed then? See this guaranteed clearing over here means it is called a settlement risk that is cleared. Okay. Guaranteed over here means settlement risk is nullified over here. What is settlement risk? Settlement risk means, let me give you an example. If you sell, let's say, shares, okay, you sell, let's say, shares to anyone, shares, okay. So this other person, Mr. X should give you rupees, right? Rupees, because you are giving the shares, Mr. X will give the rupees. So what do you mean by settlement risk? If you give the shares and Mr. X does not give you rupees, then what? Then this is known as settlement risk. So CCIL guarantees this part, provides a guaranteed clearing and settlement function for transactions in money, government securities, forex, and which I gave you. The shares, settlement risk of the shares. No, the comment section. Who takes care of the? Who takes care? Because here CCIL is very clear. CCIL is money, government securities, foreign exchange, and derivatives market. 4 clear. Does it say anything about shares? No. So who talks about shares then? Correct. NSE and BSE. NSE and BSE, these stock exchanges, they take care of the settlement risk of the shares. And for others, everything else, there is CCI. Okay? Yeah. Like that, there are some, MasterCard was having an ad few years back that there are some things which money can buy. And for everything else, there is MasterCard. Similarly over here, only share settlement risk is taken by NSE and BSE. For everything else, there is CCI. Okay. What is EWRM or EWRA? What do you mean by this? Enterprise-wide risk measurement or risk assessment. Enterprise-wise means what? Enterprise-wide means total related to enterprise, complete company-wise. EWRA or M you can call it, assesses the risk of anti-money laundering, counter-terrorist financing, means AML and CTF, and sanctions, in addition to the counter-proliferation financing and anti-bribery and corruption. Now these are important terms which may come to you in exam. Okay, so money laundering, AML, counter-terrorist financing, okay, means terrorist financing. Okay, then second is counter proliferation financing. Okay, this is again a type of this AML only. Anti-bribery and corruption. Anti-bribery and corruption. So bribery related and corruption related. So this, even bribery and corruption is part of this enterprise-wise risk, because after all it's a risk, isn't it? Thus these are most inclusive elements of EWRA. So these are all the inclusive elements of EWRA or EWRM, right? Remember, whenever you are talking of enterprise-wide risk measurement, it means you are talking of the whole company, not of a specific section. Okay? Now, before everyone, I would suggest kindly, I told you just now, join the Adda 24/7 officers Adda 24/7 channel. How to join it? Suppose if you have to join on this Telegram, okay, scan this blue QR code. Pause this video and scan this blue QR code. If you have to join this YouTube channel, scan this right side QR code, this one, okay, this one. If you have to join the Instagram channel, so scan this blue QR code, this one, okay, and you can join it. See, there are many benefits available for this, okay. So definitely I would suggest join. Everyone should join this because this is very useful to you. Remember, we give various questions, various recordings plus tests are available on these channels.
So that was the YT series for you. Now before going, let me tell you, join the batches ASAP. Let me show you how to join the batches now. Go through the app always, because in the app you're getting 1% extra. Go to Adda 24/7, click on JIB and CIB. Let me show you. On clicking on JIB and CIB, click on the CIB 24, June 24. Now you will see the victory batch. Click on this victory batch starting on 13th February. Now look at the fees, 5519, 77% off. But wait, don't go for the 77% off. I'll give you one more code. Click on buy now. Put the code Y432. Let me show you, Y432. Click on apply. Now look at this, you're getting 79% off. Plus if you do it through the app, you'll be getting 1% extra using this coin systems. So this is a huge discount offer. Go for it right now. Even you can go for the Mahapacks. In Mahapack, you get multiple batches. Let me show you that also. See this CIB Mahapack 2.0. Click on this Mahapack. Here you are getting double dhamaka offer. What is the double dhamaka offer? Double validity means you buy for 6 months only, you get it for 12 months. And also 79% off. See this 77? No. Wait. See this. Click on buy now. Then put the code Y432. Click on apply. Now look at this 79% off again. Okay. Plus you are getting 1% extra on the app. So that's why I would suggest you to join this Mahapack or the batch immediately as per your requirement. Okay.